Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Good morning, and welcome back for another weekly market recap. Yes, it is Saturday once again, at the end of a week where, from a price action standpoint, not a lot happened, especially in the equity markets. While instead, other markets like maybe gold or, God forbid, oil, they were a bit more active, so to speak. And of course, you got your currencies not doing a lot. So as a little bit of an overture, right? Now, at the time of this recording, I woke up literally 30 minutes ago, and I just had the time to turn on the TV and watching the news, which are reporting that there should have been an attack of a military attack from Israel on Iran. So, I look, I don't know. I don't know if it was a drone attack, if it was a ballistic missile, if it was a Air Force strike, what have you. And so far, at this time of the morning, they're not talking about retaliation or anything else. But, the situation for now, it's particularly hot. And we have been talking about the potential of an attack or, another conflict erupting in the region for weeks now. And remember, the US are just there watching with two major aircraft carriers right there, the Abraham Lincoln and the Gerald Ford now. So, it could go out of hand pretty quickly. It could escalate really, really quickly. All of that to say that a lot of what we are going to discuss when we look at the charts probably could go completely out the window if we have something big happening. All right. Although, it's always easy to speak about, doom and gloom, end of the world, another war, or I wonder how the market will react. Might be that we find out that, was so vastly anticipated at this point that the market already priced it in. We'll see. In other news, we got Nvidia earnings, which didn't save the market, or didn't at least boost it. And, a few more cockroaches coming up, especially in the private credit space. I'm taking a bit of time as an intro because, luckily for you, I guess, this week we didn't have a lot from the economic calendar standpoint. Yeah, I mean, we got PPI on a Friday, which came in a bit hotter than expected, but, not a lot at the end of the day. And throughout the week, what we had, State of the Union, if you are into those type of things. I don't, quite honestly. And a few Fed speakers talking, but, not a lot, which was interesting for me. So let's have a look at the break-evens instead, which, they're still trying to close in this gap, this divergence, which was formed in the past weeks. And, at least the 10-year, it keeps on drifting lower. We'll see if the 5 years will follow. I wouldn't see why not. But again, sometimes the market just takes its time, right? Getting back to inflation, PPI and whatnot, we had a particular rebound, both in the Trueflation PCE metrics and as for CPI, so the headline CPI. Now, you might wonder why. Well, I think with a little bit of a lag, but energy performing particularly well, so higher prices in energy might have an impact in this sort of metric. Usually, at least for oil, I'm used to see 2 months lag, 2 months and something lag when it comes down to the price of oil going up and being reflected, down the chain of other prices of goods and services in the real economy. So I don't know if it is completely about the energy being, particularly in an uptrend so far this year. But nonetheless, it went up. Sure, compared to the official data, I mean, we are still way below them. So, it would mean that for now, at the very least, they are still leading to the downside. We'll see how they're going to shape up. All right. Also, because, if you look at what was that? The yields. So we're going to look at the yields later on, and they didn't behave as if they were signaling inflation, especially over the last 2-3 weeks. So I don't know what type of mathematical or statistical quirk should be in here to have, especially in PCE, such a huge spike to the upside, which again, it just came back to test the levels it was being stuck at from June to December, so well over 6 months, right? GDP now, it's now showing 3%, which, after the huge miss in Q4, for Q1 2026, a little bit of a rebound after we are past the shutdown. Yeah, it could be. Yeah, we'll see, but I think it could be. And as for the Fed watch, it didn't move a lot, maybe 2% lower compared to last week, but nothing changed here. And as for the credit spreads, now on the yearly chart, so from the January 2025 to present days, so a little bit more than a year, it looks like they're starting to manifest higher highs, higher lows. So, drifting a bit higher, but again, I don't think it's something huge yet. With all what's going on in the private credit market, I don't see, for now, a huge risk of contagion being priced in by the overall credit spreads, right? So, zoom out 5 years, it's pretty self-explanatory, right? So that would be it. As for, the macro data and whatnot, it was a very quiet week. So after that, we can just jump into the charts. As for the charts, let's start out with the usual and, lately a bit boring, DXY, which this week didn't really move. We opened up the week in here on Monday and we closed basically at the same level. So a little bit of a chop, which still, after the continuation, which was negated, a little bit of a bounce in here. Again, I would say holding this region for now, which was a good pivot in the past, still kind of on the positive side of things. All right. That being said, I think there is still the potential for another push higher, but it might be a bit more choppy than what you could expect. So we'll see. Obviously, I think if we have something coming in, like geopolitical news or something like it, you might see a tiny little spike in the DXY as well. Why not? But for now, I would be more neutral than anything. What was really important for me was just to identify that, no continuation for now. So it's time to rein in the bearish sentiment on this one, because we might have, at the very least, what we are looking at, a little bit of a choppy around. So, that would be it. So it is reflected in all the other majors, as you can see, both the euro, the British pound, whoever, that all of them, right? They're all doing the same thing. Spike to the upside, pull back, lower high, and back down. No matter how you look at that, it could be the euro, or on a different type of volatility, but even the yen, right? Spike, down we go, up again, lower high, and we come back down. The only one where I think the situation is a bit different, it might be the Swiss franc. For the usual reasons, it's a safety and liquidity trade. So when things they don't look so good, this one always catches a bit. And it's interesting because, you remember sometimes we talk about interest rates differential. Well, interest rates in the US, those set up by the Fed, they are what? 3.5, 3.75. That should be the range for Fed funds, right? Now in Switzerland, they are already at zero and they are discussing going negative. And look at what the currency has done over the last, basically starting in 2023. It was rangy quite a lot. And then at the beginning of 2025, look what we got. So, the rates differential should favor the US dollar, but it's not really what you're looking at, right? The dollar is actually weakening against this one. And I know that, it might be the Swiss central bank will try to go negative to entice people and not keep on piling in, but I don't think people are, in this case, are really getting into their currency because they want to capture the yield. I think they're just trying to diversify themselves away from the US dollar, especially from the Trump administration, which could be particularly volatile, as we've seen. And, it might be that even if they have to pay a little bit of a premium to do so, or a fee, whatever you want to call it, negative interest rates, of course, they might do it anyway because they just want to stay out of the dollar, which it's going the complete opposite direction. So, a little bit of a note on this one. Moving along, pretty much the same across the board as for the other currencies, like Chinese yuan, it's still going up and up and up. South African rand didn't leave this range for now. The ruble showed a little bit of a weakness in here. I just pointing out this tiny little thing here because we left out the other week and we said that it was behaving a little bit like the Brazilian real, although the Brazilian real was looking much stronger. Well, this is the result of what we were talking about. The Brazilian real kept on expanding to the upside. The ruble failed the bounce and then rolled over. So, it was similar up until this point right here, right? And then they started to diverge. Australian dollar still very good chart for now to the upside. And, on the other side of things, Indian rupee still a very bad chart to the downside. Yeah, we got this spike up and then we are just drawing back all these leg up. Which, for a minute, if you imagine there is no gap in here, but just a very nice, huge body candle, it's nothing different than what it was in here, right? We go up and then we spend a month going back down. Eventually, we made new lows in here. We'll see about this one, but the pattern, it looks like the same, right? So for now, can't be bullish that one. Let's have a look instead at oil, which again, particularly volatile this week. And as you can see, it started out the week in here around the most recent swing high. It drifted down a tiny bit. Then on a Thursday, I remember in the morning for me, which would be kind of the middle of the night in the US, I would guess, if you are on the Atlantic coast. It was really tanking, and I was like, gee, maybe it might be signaling that they reached out to an agreement on Iran because, it's, seeing it coming down like this. While I know they're talking about making a deal, and then instead it looks like if assuming that it was for rumors of a potential deal in the making, well, even if that was the case, nope, we reversed back to the upside and we kept on pushing into Friday, max bid, and we made another high, although we didn't close through it, or maybe we did. Well, if we did, it was by a tiny bit. But anyway, the range expansion to the upside, it's clearly visible. So, targets to the upside, I would take, first of all, this one. And there is another level which could be interesting, but it's not really visible on the daily. You should have to go on the 4-hour for this one. But it's in here, more or less. And eventually, I think, very end of the day, if really something comes up and you have that spike in volatility due to a geopolitical related event, all these levels, all these potential resistance, I would say just stay the fuck out. Because if you remember what happened last time, there is no technical level which can withstand this type of volatility. So, and that is just because, both the bid and the ask, they just go dry. Everyone are trying to pull their orders because they don't want to get caught. Both the potential market operators and even the market makers. Because again, it's not like they are there for the sake of being there. They are there to make a market, and to make a market, they need to make money. If conditions, and especially in volatility, start to peak up a lot, well, what do? Well, first of all, they need to widen their spreads, right? And they might decide to, step back a little bit and offering up way less liquidity than what they usually do, because again, they don't want to take the risk, right? So, pay attention with oil. If we ignore for a minute the geopolitical landscape and we just look at the chart, which, I know it's easy to say, well, isn't it the result of the geopolitical landscape? Yeah, maybe, but I'm just trying to get the entire conversation back to something which can relate to in technical terms, rather than saying, well, if that happens, it's all out the window. Yeah, sure, but let's say it doesn't happen. What do we got? All right. So I would say again, we came back testing this level right in here. Good pace. Immediate reaction to the upside. So I would say the path, it's continuation to the upside right now, at least to this level, and then we'll see. Right. Again, if you exceed the level, so let's say you have, it could be both an initial test, a pullback, reapproaching it and breaching it, and then continuation higher. Could be straight out, clean break, coming back into it, and then continuation. So, that's something you need to assess when you get there. But the initial assessment would be, I think we are probably going there, which is not a lot. We are talking about what, $2. So, considering the current volatility of oil, I would say it's not out of reach at this point. The structure is supporting it. So we'll see. I think that would be the thing. And then we see what's going on when we hit it. All right. What else? Oh, yeah. Gold, which it's going up. And we were talking about this structure which was developing, right? High highs, higher lows. We are now at almost 5,300. So we are targeting the highs once again. I think at this point, first of all, kudos for, this is the top. It's never going to get back toward the highs. It's over. Precious metals are defeated. Well, are they? I mean, gold, it doesn't look like it. We'll see about the high, around the highs, what's going to happen. But for now, it looks constructive. And for me, if you remember, it was way better to go up slowly and in a very ordered way rather than having another type of expansion like this. And to be quite honest, I would have preferred another month of consolidation at these levels before trying to go higher again. But, doesn't matter what I want, doesn't matter what I wish, I guess. So we'll see what's going to happen. You have this tiny little leg in here, which, in case we see a rejection around the highs, could be vulnerable, but we'll see about that. For now, again, it's kind of like oil. It seems poised to go up and, should maintain that type of assessment up until you are above these levels. So these lows, basically. The moment you violate these lows, let's say, right? Something like these, right? And, you close a candle right below there. At that point, I would say maybe the momentum to the upside needs to be reassessed, or we could go in a little bit of a stage like it was in here, right? We came back down, bounced down again, so we needed to really pick up fresh inventory to the downside. And usually, these huge range expansions are, if you lose a bit of the current momentum, they are good to be revisited and potentially building up a new structure to develop and to rebuild back up the momentum that we just lost, right? So that's where I would look at as a region, as an area. If we see a very harsh rejection around the highs, and I wouldn't throw everything out the window. It's just do one very simple thing, right? See, the market is going up, right? So up until the point again we are above this trend line, I think it's all good for now. Or it depends how you want to draw it. Do you want to use candle closes? Like then it would be kind of like this, I guess. If you don't want to use the wicks, the shadows, whatever. But still, same thing. An uptrend on the daily. And since we just closed the monthly chart, look at that. It's hard to be bearish, at least in the very immediate term. So that's what I got for gold. But I'm gonna make a final consideration which is valid for all the metals, right? So let's have a look at the others, which behaved pretty much the same. Silver, platinum, palladium. It's among these four, it's maybe the weaker for now, but still maintaining itself at relatively high levels. Silver, of course, looks like the the most poised to keep on going higher. So at the end of the day, if you remember, a lot, and I do remember, I took a bit of hit for those comments 1 month, 2 months ago, right? Look, it could easily pull back 30, 40%. Yeah, right. At the end of the day, it pulled back, talking about silver, it pulled back what? From peak to trough. 48, right? So was kind of there. But at the same time, what I said was, well, I'm not arguing against the fact that these metals could keep on running over the coming weeks or months, right? Just be aware that we might get into a stage where volatility will really creep up, and don't be surprised if you're gonna see pullbacks like these. I mean, if you are used to cryptocurrencies or to Bitcoin, it's kind of the same, right? Bitcoin can have very, very huge bull markets and going up 2-3x, but in the process, from 1 week to the next, we have seen it pulling back 30-35% before keep on pushing to the upside. So, I would expect the same in metals. Obviously, I'm not expecting a 40-45% pullback every single month, but let's just say that when you see the market being particularly extended, be very nimble in taking profits, trimming the positions, rebalancing risk, because I think if you want to assume we are gonna go to 200, so basically up here, yeah, well then I mean if you assume that's the final destination, right? Well then I would also assume that the path to go there probably not going to be a straight line, but we could most likely go there, but also having something like this in the, in the process, right? So doesn't have to happen. It's not a certainty that it is going to happen, I'm just saying, be ready for it. So check your whatever type of indicator you're using to assess overbought or oversold conditions. Check your sentiment related surveys. Check the situation on the liquidity side. Check what the CME is doing when it comes down to margins and all the rest. But just because something is going up over the long run, it's not a good, to me, it's not a good enough reason to be caught in 40% drawdowns, right? Because again, if you do the opposite, if you start to the risk while the market is going crazy, then you have more money to put back to work when you have these huge opportunities. Again, opportunities in the context where you see it, keep on pushing to the upside, right? So that's what I would say for all the metals. And, again, it's same for gold, right? Probably different volatility, different drawdowns, right? The recent one, again, from peak to trough, I'm sure it wasn't a 40%. But, yeah, I mean, it was a 21. So still, not something you should discard. Like, it was nothing. So just pay attention to this. Now, having a look at Bitcoin, which is dumping right now as I speak, or at least, attempted to dump, probably overnight. Let me check. Oh, no. Oh, it just had a tiny little bit of a bearish leg on the hourly time frame 2 hours ago, more or less. So still not the picture of a health and fitness. And it looks like that tiny scenario that we postulated as for a potential bounce, which don't have the drawings anymore, but it was something like this, if I do remember. We got these lows relatively equal, so to speak. And so, and we got the ultimate low in here. So the thing was, well, look, it's ranging for now. So the hope would be seeing it deviating below the range and then quickly jumping back in and try to put together a more substantial bounce toward these highs. Now, if you think about it, right, we had the initial part because we had the deviation below the current range. It got back into it. The thing is that didn't really take those highs, right? And he just, again, the bounce was faded. It's pretty telling, right? Because usually when you have these levels which are deviated below and traded back above, the move to the opposite side of the range is particularly sharp and quick. So if you already see it, a little bit of a failure, like, even the first day, we take these high and then if you take the structure, the what do they call it? The inside structure. So, or the internal liquidity or the intra-range liquidity or structure. It depends, whatever your YouTuber influencer might be. But this is the point. Like, you see this high right in here, right? So if you're expecting the market to quickly revert back to the other side of the range, and you see that you have this internal intermediate high, we try to get back into the range, and we even swing failure this one right here. We close below it. The following day, it's a negative day, and it just keeps on drifting down. Then you know that scenario is invalidated pretty much. That's your telltale sign. It's probably not going to play out. So, assuming you bought somewhere outside of the range, as soon as you see these, immediately tighten your stop, bringing it into profit, trim the position, just in case, maybe you don't want to move your stop. Another way of managing risk, it's trimming the position a little bit. Close 30, 40, 50% of that, so that you can leave the stop where it was, but at least if you close down half of the position, now even if your stop gets hit, you are at a break-even trade, right? So there are different ways of managing risk. You can move your stop, you can go into a stop profit, or you could just trim the positions, right? That being said, yeah, I mean, it's bearish. There's nothing else to say. We tried to put together a bounce after this huge expansion to the downside, but as you can see, I mean, it came back a little bit, and overall, if you ignore all these tiny little swings up and down, right, what we got is this rollover, and it looks like it wants to go down. You got the initial push, bounce, round, kind of a rounded redistribution. I know it's not really rounded. The sketch here is just for reference. If it was rounded, you would have had at least one high in this region, which would have been a bit higher. But again, you get the gist of it. So for now, again, I had a tiny little hope on Bitcoin to put together a decent bounce, especially because it was looking like the sentiment was really, really bearish. And I guess we're not there yet. To some degree, I can understand why we are not there. I think it's a risk on asset. It's one of the most risky assets. And, it's not like the rest of risk on assets, it's doing particularly well. At least, if you compare it with the US markets, right? So what I would say is, if you think something could impact the stock market, right, you should expect that to impact, I'm talking about a negative impact, of course, to impact Bitcoin way more. And, more often than not, I would say Bitcoin, it's a leading indicator to the downside. So, yeah, we are seeing it. We'll see about the stock market. Again, many different news for now, or narratives coming up, which would be a little bit more on the bearish side. I would believe it when I see it, but that's a topic for later on. Let's close down this section by looking at what? Well, another telltale sign of risk off, yields. So now what you look at, I'm not particularly surprised about the 2 years, which, was really going down, but the move in the medium to long end of the curve was particularly good, which at the end of the day, I'm happy about it, but I guess it's the only, you can be happy about these things only if you have everything which is related to risk off. If you have whatever asset risk or risk on assets, well, you're not. So you now have the 10-year yields, which is below 4%. All right. The long bond, or the long-term yield, the 30-year yield, it's at 4 or closed at 4.6. They do move a lot from 1 week to the next. But even for these ones, if you zoom out, let's say on a monthly time scale, right? What you see is this. Basically, the long end didn't go anywhere for what? For the last, the high was in October 2023. And we have been trading in this dealing range ever since. Now, sure, you might say, well, but again, it's kind of like the gold chart, right? It looks like we got a high in here. We had a massive pullback, as you can see, but then we are manifesting high highs, higher lows. So, maybe at the very end of the day, it could still go up. Well, sure, but, I would have waited out that type of information if the rest was behaving pretty much the same. Well, instead, if you look at the short end of the curve, I think we broke structure to the downside in here, essentially. And that was what? August 2024. What did happen in August 2024? Was it 2024 or was it 2025? I was thinking about the yen carry trades, blowing up a bit, but now I'm unsure if it was, I think it was 2024, to be honest, but, anyway, we broke this level, we got back into it, and we were rejected, and we are going down ever since. As for the 10-year, again, we are still range bound, more or less, because, I mean, if you look at the highs, yeah, they are the opposite, right, of this stage right here, of this trend line to the upside. In here, the highs are actually, lower highs. So, and if you look at the lows, what you have are tiny bit of a triangle, so consolidation, not really going anywhere, but sure as hell, they all look different in one another. This was looking a bit more on the bullish side. This was looking a bit more on the neutral side, and this was looking bearish. So, if there was agreement in between all three, I would say, yeah, probably higher rates. But there was an agreement. Plus, fundamentally, I didn't see the case for, higher growth, higher inflation, and all the rest. So I think the market right now, it's, there is a little bit of a run to safety and liquidity. And again, I think it's tied not only to a slowing down economy, a labor market in the US, which is deteriorating by the day. Now we got credit, right? If you followed all the stories, it started out back in the days with what was that famous lender, first something. I always confuse that with First Bank, but it wasn't First Bank. The other one was Tricolor. They happened around the same time. So, if you remember Tricolor, right? And then we got what? Then now we have Blue Owl. And then we got the UBS fund, right? Now, if you check, we got what? We got institutions in Europe like AXA or Allianz, which are distancing themselves from private credit. So again, I think yesterday we had another type of it wasn't a blow up, but another fund which started liquidating assets in the UK. But that one was more related to real estate and construction. But anyway, you see that a lot of private credit, it's under stress. And when there is stress in the credit market, people tend to default back to what they know, or what at least they do deem as safe and liquid, US Treasuries, right? So this could be it, and this is why I think you see, look at the futures. Even those, the 10-year, it looks like it's starting, or it's at least attempting to break out of a consolidation which was going ahead since basically March 2025, almost a year, right? So, I think, it coiled up a lot. And when you see the market contracting a lot for a long, long time, and then exploding one way or the other, well, especially when you fail, like, it was coiling up. We tried to go down. We failed, immediately back up. This is what I was talking about when you talk about deviations. If you remember the Bitcoin chart, right? So imagine this one. There are a lot of lows in here, right? The market tries to break them. It's brought back in, and see how quickly the move to the other side it is, right? So, this is basically the same thing I was talking about with Bitcoin. And this is the example that usually you don't see it stalling, or, in this case, relating to that chart, failing at an intermediate high and creating a swing failure pattern and being rejected immediately. No, we immediately trade above it. We got back into it, and we bounced, and we targeted the highs. Now, sure, this is a weekly chart, so it's easy to say, well, it was quick. It took like a month, but, in the context of a weekly chart, it's not a lot. It's what, four candles, right? So, and again, another testimony of how price it's just fractal. at the end of the day, whether you're looking at a monthly chart or a 1 minute chart, there are behaviors which are going to repeat themselves over and over and over again. If you can spot them, well, you can also come up with a way to exploit them at a point. Or at least, to manage risk based on those behaviors, patterns, mechanical reactions, or whatever. Otherwise, I just assume you might do the same with a different methodology, which is all good. Absolutely, there is no there's no right or wrong. Up until the point you can do what you want to do and manage your risk. Use whatever. I heard that even astrology works fine these days. So yeah, absolutely up to you. Now, with that said, let's close in this chapter and let's move into the stock market. Although, do we want to do that again? Yeah, I guess we were. I was just questioning myself because it is something that I already hinted at in the past. Actually, I talked about it. So, do I want to bore you or not? Yeah, I guess I do. Again, we are getting back to the same old thing. China is dumping treasuries, and I already explained that when you see these lines going down, it's because they are not necessarily dumping treasuries, aka the XYZ amount of treasuries that they got, but it is also about the pricing of the repricing of those assets. If you consider interest rates went from basically 0.5 up to 5%. So, that would be one thing. All right. Okay. But we were also hinted at the fact that, it looks like China is holding US treasuries outside of China, where Belgium and Luxembourg. Because as you can see, especially if you look, the purple line and the orange line, they're going up at the same time, while the China yellow line is going down. It's much more evident in here if you look at holdings which are falling in China in black, but look what they're doing in Belgium. They are coming up by kinda, the same amount. I know there are like 100 billions difference in here, but it is just interesting how these charts are basically trading the opposite one another, right? So again, that would be another thing. They're holding treasuries. They keep on buying treasuries, but they hold them outside of the country, so not in mainland China, right? I wanted to touch back on it because maybe some of you didn't understand the reasons. So first of all, let's clear out the air when it comes down to those charts you see, those charts crime. But China is selling. Is it? I mean, if you would just look at what even the Treasury is telling you, when they do try to assess the holding of US Treasuries, the math is based on custodial data, right? So it depends where those treasuries are actually held, but it doesn't really track whose balance sheet those treasuries would belong to, right? So again, I don't know how you could be much clearer than this, right? And the second consideration would be, okay, so but why China would want to hold treasuries outside of mainland China? Well, again, one of these could be geopolitical risk, right? So just risk management. We've seen what happened in Russia in 2022 and what the US did, the US and the allies, of course. So maybe China is just trying to avoid something like it to happen to China itself. If in a particular eventual future, we might get to the point where they are, in a little bit of a much more harsh competition with the US, right? So again, they need to hold these treasuries They need to maintain or to manage the geopolitical risk. But, you might say, well, they could just sell the treasuries. Well, no, because if you read the second paragraph, it's not that easy to sell treasuries, especially if your economy, if you think about the exports, the imports, the trade deficit, trade surplus, your economy is particularly entangled with the US economy. But namely, they are your major client. So, and they pay you in what? What dollars? So it's not easy to get rid of US treasuries as reserves. Sure, you can use gold, absolutely, or you can use other US dollar denominated assets like stocks, but when it comes down to build up a portfolio, even if you are a country, you can't have only risk on asset. And I'm categorizing gold as a risk on asset because since it doesn't pay you a yield, it doesn't pay you a dividend, the only money you can make by holding gold is that if the price of gold keeps on going up. So that's a risk on asset. There is no intrinsic income revenue for you for the simple fact of holding it. So yeah, that's a risk on asset. So, when you build up a portfolio, maybe China needs to consider that, right? Then, these are basically the 4 rules or 4 reasons, so to speak, which would explain why China would consider convenient for itself, right? Holding US treasuries outside of mainland China, right? So, can just read them all. I'm not going to read them all. I'm sure it's pretty clear if you read them. But as you can see, instead of the usual, well, China is selling treasuries, or China is leaving the dollar system, maybe not. After you dig and you look a bit deeper and you take a look under the hood, might be that, first of all, although they might want to leave the US Treasury and the dollar system, looks like they cannot for now, because that would mean that they would absolutely need to find a replacement for the US market, because if they don't, considering they are a nation which lives to export, and there is no other nation on earth which is able to absorb all their surplus, well, if they cannot sell it outside, can they absorb it internally? No. So what's going to happen? Well, they just find themselves in a situation where they are overproducing. And what happens when you are overproducing and you're not able to sell out the things you are producing? You need to cut down the production. Therefore, you need to cut down what? Jobs. Which leads to cut down wages, which leads to cut down purchasing power, which leads to less aggregate demand, which leads to a slowdown in the economy. In a country which is already in a precarious situation from a demographic standpoint, you can see why it's massively, massively hard for them to completely divorce the USA. Now, I'm not saying it wouldn't be painful for the US to divorce China for different reasons, but it wouldn't be a pain-free process. Absolutely not, right? But again, why yields were going up? Well, because, there is an inverse relationship in between yields and the price of the underlying treasuries. So if everyone is selling treasuries, yields will go up. Actually, dumping treasuries, it's a weapon that China could use against the US, right, in order to force or to corner their credit markets, since they have a lot of debt. Okay, but then you look at these, and you do realize that if you look at a composite of GDP and inflation, there is a very nice correlation in between what? Growth and inflation expectations and interest rates. So you could keep believing that rates went massively higher, even at the long end of the curve, just because China was dumping treasuries, which in part, partially it is. Not only China, when the DXY went from what? it got up to 113, 114 in a matter of less than 1 year. When you see something like that happening, you must expect that someone is selling treasuries. Not because they want, because they have to. What are treasuries for us outside of the US? Reserves. When do you use your reserves? Oh, rainy days. Shit, my currency is crashed against the US dollar, and everything abroad is priced in dollar. Energy, metals, other commodities that I need. I need to defend my currency, otherwise I'm not going to be able to purchase those commodities that I need in my country. How do I do that? Oh, look, I got all these treasuries. If I sell them out, I get what? Dollars. And then what? Then I sell the dollars and I buy back my own currency to sustain the price of my currency against the dollar and not being fucked on the geopolitical worldwide economical landscape. That's it. That's why you see people selling treasuries, because they need to, not because they want to, right? Interest rates would go up for that. Yeah, sure, in that event. But in other normal circumstances, interest rates go up because of these two factors. What do we have in 2021, 22, after the pandemic? It's not like we spent a lot of money throwing billions and trillions at the economy, while at the same time shutting down supply chains. I wonder, could that lead to inflation? Yeah. But at the same time, could it also lead to growth if we keep on pouring money into the economy and stimulate that? Yeah. Which is why you've seen rates going higher at the very end of the day. Primarily, I would say, right? Now, is it a problem? Is it not? It probably is, but I guess it is something that either will get back into balance by market forces and in time, right? Or again, if we're gonna keep on doing the same stupid things, when the next, I don't want to even say crisis, but when the next crisis signals or potential start to unfold themselves, we are probably going to play the same playbook, and we are going to be fucked once again over the long run, right? So that would be it, just to add a little bit of context on the why China would prefer to hold treasuries abroad, right? So after that, I think it's time to look at the stock market. Now, the stock market was a little bit of, more of the same. Essentially, we started out the week, as you can see, on Monday, we opened up the week in here, immediate drop. We got back up in still overnight session, but the European session. Then we got the US markets opening up, taking out the high of the London session, testing back into the weekly open, and just dropping back down, taking out Friday's lows, right? Now, that was Monday, so not a bad start for a Monday, all right? Then Tuesday, little bit of a pullback, relief rally. European session was choppy. We had a huge drop when the markets opened in the American session. We got ES futures taking out Monday's lows, right? But NASDAQ futures, they didn't, right? And we kept on rallying for the rest of the day, going into Wednesday, where, a little bit of a continuation overnight, a London session just started to push up, and we kept on pushing higher for the rest of the day, getting into what? Now, this is where, quite honestly, you need to ask yourself, why the market is pushing so violently and so quickly in what? To a news event. Because what do we have? On a Wednesday, we got NVIDIA earnings, right? After hours, so, the market closed around the highs, right? Then we got earnings for NVIDIA, which basically went like this, right? This is where they were released, more or less. Initial pump, faded right away, and then, just dropped like a rock. although, at the end of the day, earnings weren't bad. I'm not going to bore you with the entire table of contents, but just the raw numbers. If you look at revenues, expected at 65.9, they came in at 68.13, so 3.4% above expectations. And if you look at earnings per share, they were expected at 1.50, they came in at 1.62, so 8% beat. So no matter good results for Nvidia, the stock was punished, and as you can see, it brought down the entire market with it. But at least obviously the S&P, the Nasdaq, to a lesser degree maybe the Dow, but again, everything just went down. And on a Friday, again, Friday started out a bit, kind of like Tuesday. Was it Tuesday? Yeah, kind of, yeah. So a little bit of a relief rally. Asia keeps on drifting higher. Then London session pushes lower. And the rest of the session for the US, it was just chopping around and staying into the initial. I think we closed the week into the initial balance for the session. So, below the weekly open for all of three at the end of the day. And I think there are, also end of the month dynamics in there. So positions which are readjusted, trimmed, the last day of the month. I usually don't really like it because either it keeps on going in one direction and you can't really get in anything relevant, or it just chops around. And it doesn't mean that you can trade it, but actually on a Friday I didn't even touch New York. I called the week after the London session, so which all of these, right, leaves us with what? Well, again, a little bit of more of the same, where you have the S&P, as you can see, it tried to make a new high, was basically rejected at this point of release in here. The Nasdaq just took out these recent highs, just a sweep, a ring faded pattern, if you want, and we immediately dropped back into the bulk of liquidity, so into the previous range, right? So attempt of a breakout failed in here, right? Again, now, especially if you look at the S&P, the more it fails at new highs, the more these starts to look like what? Around the top, maybe, right? Now, it is also true that up until the point you don't break the base, which would be at this point kind of like in here, right? It's not all said and done, although, doesn't look pretty, that's for sure. So I think the risk, I would say the risk is increasing to the downside, but, up until the point you don't have a break, I would wait a bit more, more risk, but not confirmation. As for the rest, we might find support in here, and we got a major support in here. So, assuming you have a correction in the S&P, right, from here, what could it be? 2.5% to one of the first expected bounce. Or if we get back to test the old double bottom, 5-ish% type of correction. We'll see. Again, it's not said and done. Nasdaq looks a hell of a lot weaker, to be fair. So getting back to what? Assuming this is a rejection and we just go down from here. Well, these lows would be the first. So 20. This area, 24,600, 24,300, this range, this 300 points range. But I think it wouldn't stop there. Maybe a little bit of a pose, a little bit of a bounce. But if we start to break, I think the Nasdaq will get back below 24,000 at that point. If we really start a correction, right? The others, so the Dow, again, not a lot changed. We were looking at these box, if you want to call it that, these range right in here. I think last week we were looking at these, right? And we deviated above it. We got back into it. And now, as you can see, we retested the low side of the range. And it's, a bit more sloppy, but it's kind of the same for the Russell 2000. So at the very least, what you could say is that there is no, for now, at the very least, intention to keep on grinding to the upside. Not even in these two on the right. So that could be a telltale sign maybe of a market which is now weakening a little bit more broadly, right? Again, nothing is said and done. It's just, for me, the risk, it's increasing a little bit. And the only way you could be, a little bit more, let's say, relaxed, like, the usual, oh, finally, we're out of the woods. We need to start making new highs on a daily time frame at the very least, right? Now, we knew that February was a bit on the weaker side from a seasonality standpoint. So, that could be, could have played a role, probably, okay? But let's have a look at the ETFs. So what you see, it's the NASDAQ, it's basically being rejected at the 100 days simple moving average, which, again, it's the one in white, provided support in here, in here, in here. We broke below it, we got back, rejection. Back again, so far, rejection. While instead, the S&P, as you can see, SPY in this case, it's still a bit more resilient above it. So again, relative weakness in the NASDAQ. Now, speaking of relative weakness, let's try to do this. Didn't really check this one for a while, so let's have a look. Let's have a look at SPY against the RSP. So I just wanted to check the relationship in between SPY and the equal weighted index. So let's have a look. Well, I mean, let's go year to date. So for the first 2 months of the year, as you can see, clearly the equally weighted index it's overperforming the general market cap weighted index. Now, if you zoom out, sure, it can change, right? If you look, let's say, from the April lows, right? The tariff tantrum that we got last year. I mean, it looks like they're shifting, right? One, it's crossing to the upside relative to the other. But even if they don't cross, like, just look at the delta, right? It looks like you are transitioning from a situation where the market cap weighted index was vastly outperforming the RSP. Now RSP closed in the gap, which means, as we've seen for basically 2 months now, that you have a lot of the market which is rotating from the high beta, high yielding, high returns, high risk, high volatility stocks into something which is a bit more on the defensive side. And again, we have seen the different sectors, performing particularly well: staples, utilities, finally, energy, right? So all of that in a context where we just had the Supreme Court ruling tariffs and said tariffs were not constitutional. Although, again, we said, well, look, they're not going away, most likely, at least not in the short term. The president already implemented new tariffs. Yeah, I mean, 150 days. But look, they could actually go to a congressional process and make them legit this time around. I don't know, as long as they do it before midterm, because I think they're gonna lose at least the House at midterm. So, I mean, given the recent polls, who knows? About surveys are not always accurate, but we'll see about that in November. We still got time. What's really important for now is that if you look at the tariffs rate that we got before the the Supreme Court actually ruled, is it massively reduced on average overall in aggregate? Well, since the start of the year, it just went down from 10 pp to 9 pp, which again, percentage points, just for the sake of it, right? So is it a massive change? No. Plus, do you remember those betting markets like what was that? Poly market or Kalshi, something like it. I mean, it's not like these decision by the Supreme Court wasn't priced in. Everyone were already betting on the fact that tariffs were illegal in the framework they were implemented upon. So, don't you think the market already priced it in? So, plus, again, even if you were betting on tariffs potentially, we've seen that when they were implemented, the market dropped. So one would assume, well, look, if everyone is betting they are going to be slashed down, well, no more tariffs, the market should rally. I mean, if it dropped when they implemented that, now if they take them away, the market should rally. It didn't. Not even on the news, right? That potentially they were to be ruled out as illegal. So probably the market didn't move the way it moved so far this year because of tariff talk or the Supreme Court, but there must be something else brewing below it, right? So for market internals, what we can see is that there is a not indifferent amount of short interest if you compare it with the market cap, right, of the S&P. So are people starting to cover their long-term positions? Maybe, who knows? Another funny thing is that if you look at the year-to-date, and I know 2 months, it's not a lot, but if you look at the returns, you see that, for instance, there is not a lot in sectors like communication, tech, or financials, while instead there is a lot in healthcare or in energy, materials, industrial, staples, all the usual suspects we have been discussed. So again, the market, it's seeing a decent amount of short interest being built up. We got the sectors which are usually the main drivers to the upside for the market being particularly weak. And then what? If you then check what type of short interest it's built up, divided by sectors, well, what you see is that, a lot of new short interest actually is being built up in what? If you look at the percentile rank, right? Consumer staples, healthcare, utilities, energy, materials. So basically everything which was rallying these last 2 months. Now, just because you see short interest going up, it doesn't necessarily mean that you will see a drop the very next day. But it just means that most likely a lot of people are seeing these markets being overextended and they are trying to protect or to hedge themselves. Could be normal speculators like hedge funds or whatnot. Or, it could also be the market maker if you think about it. I always think about the commitment of traders type of, that type of chart where you see the speculators are usually on the opposite side of what? The commercial, right? So, this is just because someone, if everyone is long something, someone might have offered that market to them in order to be long. And what do you think it's going to do? The market maker, which was offering you the market you want to bid in order to keep on making money to the upside. It's not like the market maker is gifting you with money and losing, right? They hedged. So, I think at a point this balancing between short interest, long interest, it could be a telltale sign that, people are starting to realize these markets are a bit overextended. Could they overextend a bit more? Yeah, absolutely. And, it could also mean that let's put it this way. If you step back and if you try to go farther back in time, right, you might say, well, I wonder if those same huge short interests were built up on sectors like tech or, consumer discretionary or financials before they pull back. But maybe. And if that's so, the fact that now, if you keep on checking the percentile rank, they got back to much more lower level, right? It means that a few of those shorts might have been closed. So, it's just intermarkets dynamic. You do what you want with that. I think at the very end of the day, what really scared the market in these sectors, especially the tech, it's that we transition from a situation where these companies, which were leaders to the upside, they had a lot of free cash flow. And now, because of all the AI build-up, CapEx went through the roof. They actually went out of free cash flow because, if you look in blue, you got the cash flow, which is flattening, but you got CapEx, which is now going above. You check the delta and you see that, well, no more cash flow. Which again, for an investor, it's not the best sign of all. Although, all things being said, if you check the fact that, sure, they are running out of cash flow, so now they have to fund this build out with what? Well, with debt. You've seen Google issuing debt, who basically everyone, they all did it, right? Or they just took out loans, whatever you, right? They just tapped into the credit market. And I know the narrative is a little bit scary, but beside Oracle, right, which again, 4.4, if you check the debt to equity ratio, right? All the others are still in a good enough situation in order, to take more debt. I'm not saying that getting into debt, it's wonderful. I always try to differentiate that, not all debt is created equal, right? If you have debt, which is using to finance consumption, that's bad, right? But if you have debt that you're using for investing in productive things, which are going to yield you more in the future, that's a very good use of debt and leverage, or whatever you want to call it, right? And, although the narrative now is that the Max 7 are done, they don't have the money to keep on growing this build-out, CapEx will need to be cut down because the stocks have been punished so much. At the end of the day, if you just check the ratio in between the debt and their equity, they're still below 1. So it's not a tragedy, right? And plus, if you look at the earnings growth, they are still the ones which are growing earnings and revenues at the faster pace in the market compared to the other sectors like staples, right? You remember that the parallel in between Nvidia and Walmart, right? I mean, Nvidia is growing revenues of what? 50% plus year over year. In a sector which is new, AI, right? Versus Walmart, which is growing revenues or earnings at what? 4-5% in a sector which is mature at this point. So it's hard to keep on growing those earnings growth right into the future if the sector is mature. So I think, as any other narrative, it might take a few weeks, it might take a few months, but there might be a point where these fundamentals will play a role, right? So be careful making definitive assumptions or statements about the state of these Max 7, right? Because I think at a point the risk will be to the upside, not to the downside. Will we need to see a 6, 7, 8% correction before that? Maybe, but just if you're in for the long term, you might see it as an opportunity rather than a doom and gloom type of scenario, right? Other than that, other risks or narratives which may keep the markets down. Again, we were talking about private credit, and if you check the BDC, you remember we were looking at Blue Owl over the last 2 weeks. It looks like this week we also got another one of these funds. I think it's KKR or KRR. There was a K and there was an R. Probably was KKR. It's another fund which is investing in private credit, therefore facilitating the creation of new companies by collecting capital and then putting it to work. Some sort of a venture capital, but just related to private credit, right? Which, again, as we were discussing, has been democratized. So even the retail mom and pops now can have access to it. And guess what type of deals these highly sophisticated Wall Street managers is going to come up with when it comes down to deal with average people, normies, average Joes? Do you think they're going to present you the best deals? Or maybe they do know they have a few deals on their books which are never going to see the light, and they need to unload themselves or their balance sheet of those shitty deals they made. What do you think they're going to come up with when it comes down to, allocate or, to propose that type of opportunity to retail investors, right? And again, I think, many different things are not playing well right now. When you see a fund which is shutting down withdrawals and redemptions, even the not so sophisticated retail investors can see that something is not right. And this is why you see that slowly but surely, a lot of people are starting to pull back, right? And again, I mentioned at the beginning of the video that even if some European companies like AXA and Allianz, which are insurance companies, they are pulling back and starting to deem the space as not favorable, and they use the term, we need to take distance from these instruments. So, take it as you want. It doesn't look or it doesn't sound positive to me. Still, for the internals of the market, if you have a look, since we are looking at a NASDAQ, which is particularly weak relative to the rest of the market, if you look at the aggregated put to call ratio, looks like we are at a level where in the past we were kind of near a low or at a low. Now, I'm not saying this is the low and it's going to go up from here. I'm just saying, it's another form of imbalance, right? When you have a lot of people which are all on the same side of the trade in relative terms, relative to those which are, on the opposite side, right? In this case, a put obviously expresses a bearish view on the market. A call expresses a bullish view on the market. And you see imbalances like these, more often than not, it can lead to a move into the other direction. Again, I'm not saying it should be tomorrow or next week, but, in time, right? I mean, even if you look at these, right? You see that these ratios started to go up. Yeah, sure, but, it was 2023. We needed to get back, to get into October before seeing an actual low, right? So the market stayed in these conditions for weeks. But, it might be a telltale sign that something could actually, in time, see a bit more of a dovish resolution, so to speak, right, or conclusion, right? Then, again, in the short term, it might be a whole different thing. If you are familiar with the gamma environment, if there are a lot of puts and the environment starts to be negative, market makers would need to chase the market in order to hedge themselves, which could add up on the selling pressure, and making the market particularly directional. So yeah, it could exacerbate moves to both directions. But in this case, if the sentiment is particularly bearish, it could exacerbate moves to the downside. So we'll see. But over a long enough period of time, it might come to be a different resolution, right? Just differentiate the time frame in between your daily time frame and your weekly and monthly time frame, right? So what else? I think there's not really anything else. This would be pretty much it. I don't feel like I have a lot more to say. For completeness sake, let's have a look at the heat map. But again, a lot of green, a bit of red. Problem is that the red is in those sectors which are particularly heavy from a market cap standpoint, on which is why at the end of the day, what you see is this. So I think it's a good time to be nimble, but up until the point you don't have confirmations one way or the other, just bear in mind your critical levels and pivots and try to manage risk as good as you can, right? There is nothing else to say. We'll see what's going to happen. And again, got the TV on the side here, which is still on, although muted. I'm not seeing any new developments about this thing in Iran. So who knows? Again, wake up on a Monday morning and the market might gap down harshly because something went on in the Middle East. I don't know. We'll see. This is something we need to observe in real time, both for stocks, for metals, obviously for oil, right? And, I would say even for the DXY and the yields, right? Those are all legs on opposite sides, like, for instance, yields, they keep on dropping, risk off. DXY, if it pushes higher, risk off. Gold, pushing higher, risk off. Stocks, of course, risk off, should push lower. So, same, and again, Bitcoin, again, should do the same. So I think it would be a very interesting beginning of the week. We'll see how it plays out. From the economic calendar standpoint, do we have something relevant next week? I don't honestly know. I didn't check. ISM PMI, and then what? More Fed speakers. Again, services PMI. Usual jobless claims. And on a Friday, what? Oh, wait. Wait. Well, we got NFP on Friday, so yeah. Oh, okay. All right. This one is going to be for February, so even the economic data are catching up after the shutdown, finally. So unemployment rate, NFP, labor market data on Friday, which could be a market mover. So the week might start out volatile depending what happens in Iran, and it could keep on being volatile with macroeconomic data coming in toward the end of the week. So stay sharp, be nimble, and again, as usual, don't lose your shit. That being said, I wish you a very good rest of your weekend. It's incredible. It's just 10 a.m. I'm pretty early this week. And I'm going to check back in next week. Up until then, be nice and be cool. Neil's out.
What have I told you since the first day you stepped into my office? There are 3 ways to make a living in this business. Be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.